Let me introduce my first guest of the day. We've got Feroze Azeez, Deputy Chief Executive Officer of Anand Rathi Wealth. Thank you so much, Feroze, as always, for taking the time, and good evening to you. You say statements like asset allocation is 9/10 of the rule. You say things like diversification is absolutely important. We've been saying this for years, I think. But why is it so important? Why is this the case?
Good evening, Alex. Like you said, this is something which we, all of us, have repeated several times. And I think there's still a need of repeating it several more hundred times. Because we, if you look at the data, it very clearly says that diversification has not happened amongst we Indians. And even if it has happened, asset allocation has happened on financial assets. Today, if I recollect an instance where there were about 200 HNIs and ultra HNIs in a room in one of those roadshows I was doing, where we actually gathered the information which people have of real estate, it turned out to be 62%. So the point I'm trying to make is we as Indians don't follow this principle of asset allocation correctly. You may have 62% in a real estate component, which for the last 10 years, residential real estate has given you only 3% return, and the rest of it might do however well, but the overall balance sheet of a person will not do very well. So the point I'm trying to get to, Alex, is that diversification is very critical, point one. Point two, diversification is not just for financial assets, it's on your entire balance sheet. Indians have close to 60 to 70% of their money in physical assets and have 5-10% in equity. Which I think is not a fair proportion when compared to the globe. So please, when you look at diversification, look at it as a balance sheet item, not just the financial asset. That's point two. Point three, why is this important? If I take an example, if markets, let's assume you create a portfolio only with equity. On the contrary, if the market falls 20%, your 100 becomes 80. If you have a 50-50 portfolio, if the market falls the same 20%, if you have 50% in equity, 50% in debt, when the market falls the same 20%, you will lose only 7.5% because the debt will give you some return, equity will diminish by 20%. So the point is, diversification acts like a shock absorbent, in a car. So that's why it's very critical, Alex.
You know, or your team has sent a table in which we've been playing out on the screen, which has given you the return range over a period of 3 years in percentage terms. And there's also a risk associated with that, which has been measured, right? So how would you explain this? You've talked about equity, debt, commodities, which you've talked about in terms of gold, and you've talked about real estate. How would you explain this?
Sure, Alex. I'll attempt to explain this because most of our viewers would not be acclimatized to looking at risks numerically. So if you look at equity has three vehicles to participate into. Like, for example, the most conventional one is to buy a stock directly. That's one method of participating in equity. The second is use PMSs, where you buy a group of stocks through a fund manager, especially the HNI vehicle. And then we have the conventional great vehicle of mutual funds, equity mutual funds. So these are the three vehicles to participate in one asset, which is equity. So if you backtest the results of performance return on a 3-year basis, the rolling return for the last 20 years is in the range of 10 to 18 for stocks. And I'm speaking of large stocks, top 100 stocks. Mutual funds has been 12 to 14, and PMSs has been 14 to 30% return. So these are return numbers which are easy to comprehend. If I spoke of the corresponding risk numbers, risk can be measured in a variable called standard deviation, which tells you the possible oscillation in the return. If you buy a fixed deposit, if you have thought of getting 7%, which is your expected return, you will get exactly 7.00 at the end of the period, as long as the bank is solvent to pay you the money. So the risk number there is 0. If you buy an equity fund, you may expect 15%, but no single year will you get exactly 15.00. It can oscillate from 10 to 20, for example. So this standard deviation helps you understand what is the oscillation possible in the return which you expect.
Fantastic. Okay, so and honestly, Feroze, I couldn't have explained it better. Very few people can. So thank you for that explanation. But when you talk about uh, each component of this, right? You're talking about various asset classes. You mentioned in that room of HNIs that you were in, surprisingly, 62% of their assets on an average was in real estate. But the question is, what do you compute in that? Do you count, for example, the house that you're living in as part of your assets? Because you're not really going to liquidate that. That's the reason I'm asking. If you are investing in real estate as an investment, which we encourage people to look at, right? Again, if you're talking about gold, if you're investing in jewelry and thinking of it as an investment, that's not necessarily the case, because you're not going to go and pawn your jewelry. At least not if you're, you have a choice in the matter. So how do you look at this?
I think it's a brilliant question, Alex, and an important question to answer. Otherwise, that example could be misconstrued. When you look at wealth, you don't count the assets which you consume. If there's an office space which you occupy, that's not a part of wealth or a balance sheet from an investing standpoint. The house I occupy is not counted as a balance sheet item for me. It's not a part of wealth. It surely is a part of your net worth, but not of your wealth. So point is, the 62% of that small survey which we did in the group of 200, which may not be the right representation for the entire country, but that's a reasonable, in the order of magnitude, the number is correct, 62% in real estate, is only for invested real estate. Quite a few of us end up falling for some builder's apartment, thinking that's a great investment. Investable real estate is what you count in wealth, and you try and manage that. Second, when it comes to gold, again, you rightly pointed out, all the ownership of gold is not in the form of coins, bars, ETFs, or gold funds or sovereign gold funds. The jewelry is definitely not counted as wealth, because even if the price triples, if I want to wear that piece of jewelry, I'll continue to do so. And especially if I decide to sell all the jewelry, my wife would definitely divorce me. So the point I'm trying to make is, there's a consumption item that's not a part of your wealth, it's the part of your net worth.
Yeah, no, certainly. I think you and I will share maybe a coffee somewhere after, if we end up doing that, and we'll talk about it. But having said that, let's move on to the next point, which is the importance of equity, because I think that's another statement you made. Equity ends up, because of these very reasons, forming a very small percentage of your balance sheet, like you mentioned, or your wealth. Why is that a bad thing?
Yes, Alex, it's a bad thing because data says so. Now, for example, I'll tell you, when we sell every property for our client, we help them sell. Like last month, we sold 7 properties for our clients, helped them sell 7 properties. The average return was about, if I remember right, 8.3% for all these 7 properties. They had invested 5 crores. It became 23 crores. Looks good. 5 crores invested 10, 12, 13 years back had become 23 crores. But if they invested in a simple equity mutual fund, and for illustrative purposes, we had taken HDFC Flexi Cap, which has lasted for 25 years, as one of the examples, 63 crores could have been earned more. The point, coming back to your pointed question, when you look at hundreds of properties and compare it with the opportunity cost of investing in equity, crores and hundreds and thousands of crores has been lost. That's why neither is real estate good in high quantums, nor is equity for that matter. Equity is one of the few asset classes which gives you the benefit of having the liquidity, having the money at a call in 2 days, 3 days, and the best advantage is it has the power of compounding, right? Real estate or physical assets have a very less power of compounding. Equity has the power of compounding. But of course, it's more risky because it moves up and down every single day, unlike physical assets. If you look at a portfolio with adequate quantity of equity, it has the power to beat inflation, and especially in current contemporary situation, inflation is something which is the talk of the town, and we have duty bound to beat inflation as wealth owners.
Very fair points. When it comes to diversification, especially over the last 2 or 3 years, it's this conversation about international equity has entered a wider spectrum of conversation, I think. We've been speaking about it much more often than we have in the past. Again, I think. But how important a cog in the wheel of diversification is international equity?
Yes, Alex, before I go to international equity, just let me give some numerical integers to inflation and its impact on a portfolio which does not have equity in a minute. So if somebody had zero equity and 100% debt, and inflation is at 7.5%, you have made a weighted average return of 6% over the last 10 years. So you've not been able to beat inflation and you've underperformed inflation by 1%. If you actually ran a 100% equity portfolio, your average return for the last 10 years would at least be 14%. So you've beaten inflation by 7%. The answer lies somewhere in the middle. If you had an 80% equity and a 20% debt portfolio, you were able to beat inflation by 5% an annum. That's right. So not having at least 30% in equity will be a short way of underperforming inflation. So now coming to your pointed question on international equity. International equity, of course, has diversification on two counts. One is that it is equity, it's global equity. The behavior of that could be different, not dramatically, but different than Indian equity. That's one. The second is when you buy international equity, you're also taking currency exposure. International equity is not quoted in rupee. So when you buy an international fund, international equities fund in India, it might be quoted, the NAV might be in rupee, but you are getting the benefit of rupee depreciation, which is again a very contemporary topic that we are close to 80 rupees today per dollar. So it is a good diversification tool. But I personally think over the next 5-10 years, Indian equities has the power to outperform several global equities. So from a diversification standpoint, it's a win. But from a contemporary investing standpoint, it should not be a substantive quantum of one's portfolio.
So, and would you say then, therefore, again, there is no one-size-fits-all solution, but 10% is a fair kind of an allocation to international equity. And of course, the SEBI has come in, and the RBI also, of course, involved in the cap on investments by domestic mutual funds into international assets. And so we're still waiting for that threshold to be changed. But in the interim, what are the options available right now, Feroze?
See, the options available is, of course, liberalized remittance scheme, especially in the day and age of technology. On a click of a button, you can use the LRS limits. Way back when capital convertibility was permitted to the extent of $200,000, I think it was 2006, 2007. That time you had to open a bank account in Dubai or in Singapore. That's what Indians would do, and remit money to those bank accounts and then do global investing. Today, it's far more easier. So use the liberalized remittance scheme. In fact, to my mind, allowing international equity through mutual fund itself is a loophole. Because if RBI keeps a limit per individual of $2.5 lakh, which is $1.5 crore, then in the mutual fund, if an individual does not have a limit, I can invest $2 million through a mutual fund and circumvent this RBI's limit of $2.5 lakh. So if RBI has put a limit per individual, I think the mutual fund investments of international equities have to form a part of that limit, which it was not. That's why SEBI has had to put a cap at an industry level as against an individual level. And liberalized remittance scheme is a reasonable quantum every financial year per family. If you assume a family of 4, you're speaking of $2.5 lakh per year, per financial year. That means close to $1 million per financial year. A nuclear family of 4 can invest globally. And why should you actually have a mutual fund route also permitting you a global exposure?
Important. We spoke a little bit about gold and we spoke about real estate, but I want to understand how much gold, how much real estate should you ideally have? This is a difficult question, Feroze, for a lot of people, because if we're listening to our grandparents, then that's going to be a very different number from what perhaps you and I will talk about.
So I would say gold, to my mind, sovereign gold bonds are a very, very good vehicle. So if till sovereign gold bonds were not there, I would recommend very minute components. A 5 to 10% allocation to gold can make sense, especially given the fact that in dollar terms, gold has not performed. In rupee terms, we see 50,000 and get excited. But in dollar terms, for the last 40 years, it has just doubled in 40 years. The year I was born, it was $800 an ounce. And today it is at some $1,700 an ounce. So in dollar terms, gold has not given the return. So our ancestors who have invested in gold have not made money because they invested in gold. They invested in effect in dollar. And dollar has appreciated is why we see gold to be at 50,000 in Indian rupees. So I would say a modest amount of 5%. And if somebody has global objectives like a foreign holiday, sending your child abroad to study, these two, both international and gold, international equity and gold funds have the power to buy you dollars sitting in India. And that's why 5% in gold is a reasonable amount, especially using a sovereign gold bond, which gives you 2.5% interest over and above the gold price and gives you long-term capital gains at zero if held till maturity. There is no other asset in India which has zero long-term capital gain if held till maturity other than the sovereign gold bond. And of course, ULIPs below 2.5 lakhs per annum.
Important point, especially with regard to the gold and the dollar that you're basically gaining. I think your ancestors might not be very happy with that, but neither will mine, I'm sure. Having said that, let's talk about real estate. Again, 60% is obviously too much, but how much is too much then?
I think if you take a cue from how global investors who are far more seasoned and don't go by emotions, would say that I think the global exposure on real estate from an investment standpoint, I was reading a study, is about 16 to 17%. So I would say anything more than 20% in real estate or 1/4 in real estate is too much. And especially because of the kind of illiquidity, the transaction cost, the hassle of managing that property, sometimes renting it out, making sure there's no litigation, making sure that there's no encumbrance on the property by litigation. All that, I would say anything more than 1/4 of your money, other than the house you consume, if it is in real estate, I think you've gone overboard on an asset when especially the global investors have kept it at 16%.
Final point then, Feroze, with regard to real estate. A lot of younger people that I'm speaking to are not too keen on buying real estate. A lot of people are happy living on rent. So then, therefore, with the perspective of diversification, would you say REITs is good? Has it developed enough for you to consider that seriously as an option?
To my mind, no. The reason being that today you have in India, the interest rates are reasonably high, right? In a global environment, if REITs have done very well, because you would have to have an infrastructure project in which a person will get some cash flows. Because the interest government Fed would pay would be 1%, 1.5% for a 10-year paper a while back. In India today, if you have a 10-year GSEC at 7.3, 7.4, if you can lock in your return with the government of India at 7.3, 7.4, an instrument which has an expected return of 9 with that kind of complexity, or 10, does not figure in my list of efficient product platforms.
I think it's been a fruitful conversation, Feroze. And I'm sure that my wife will have a good laugh at certain parts of it, certainly. But thank you so much for taking the time.